Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, February 15th, 2021, and I'm pre-recording this Trading Places Live for Tuesday, February 16th. Futures currently are solidly higher after the S&P 500 closed at an all-time high on Friday and following a three-day holiday weekend. So it looks like we'll get off to a good start on Tuesday. Of course, we do still have to negotiate the evening hours, but as of Monday evening, it does look like Tuesday will get off to a good start. We'll see. All right, before we get into anything, I do want to go through the agenda with you. I'll go through the daily market recap from Friday, and then we'll get into talking technically. I want to talk a little bit about the volatility index. Then we'll get into seasonality. I want to show you a few charts in February, companies that tend to perform really well in February and are doing it again this year. And then we'll get into earnings spotlight. Number of companies will be reporting on Tuesday, so we'll go through, take a look at some of those, maybe take a guess as to how they may report based on how they're trading. And then we'll wrap up with the three you must see. Got three really interesting charts for you today. All right, before we get into any of that, I do want to take you over to earningsbeats.com. If you'd like, you could check out our service. Hit that Join Today button. There is a, basically, it's a no-cost 30-day trial. And if you come in now, it's a great time to sign up because if you do come in, you will be able to attend next Sunday evening's top 10 stock selections where we unveil the stocks that are going to be going into each of our portfolios. So we update these portfolios every 90 days. And we're just about ready to end the current quarter, which you can see, like I said, tremendous performance right down the line. And we'll be putting new stocks into these. Well, some of them may be the same. They may carry over. But there'll be a number of new stocks as well. Based on recent earnings reports, the way the market's trading and so forth, these are stocks that we're going to be willing to go along with for the next 90 days. So I think you'll find that very interesting. Again, you do need to be a member for that, but you can be a trial member. You don't have to be a full-fledged member. So if you go in and give us a 30-day no-cost trial, you'll be able to check that out on Sunday. All right, let's keep moving. I want to talk a little bit about Friday. It was a pretty good day in the market. See the Dow Jones Industrial Average up 27, closing at 31,458, not too far from 32,000. We're going to get there, I think, sooner rather than later. S&P 500 up another 18 points, almost 0.5%, closing at 39,3483. That's an all-time high. S&P 500 poised to break above 4,000. I'm going to talk about that in just a few minutes. NASDAQ up 70 points, up 0.5%, closing over 14,000 for the second straight day. Actually, it might have been the third straight day. Mid caps up 9 points, about 1/3 of 1%, and then small caps up a couple points, which was up a little smaller fraction as well. But overall, all the major indices trading up above their 20-day moving average, which is above the 50-day moving average. And just recently, we had tests of the 50-day and on some of the indices, the 20-day. And we've broken back out the new highs, which is very bullish. And look at all these AD lines, accumulation distribution, all now breaking to new highs. Very bullish. Energy was the top performer on Friday, up almost 1.5%. Still trying to break above the January high and also the high that was established back in June of last year. I'd like to see it get through 45, and while it is doing better and better on an absolute basis, you can see that accumulation distribution also strengthening. We still got some work to do on a relative basis, and I'm not just talking about the last few months. Last few months have been solid, but you know we're talking about a sector that has underperformed the S&P 500 for nearly a decade. So for it to go up for a few months is nice, but we want to see consistency. And so I think it's going to be key here at this $45 level to see whether or not we can get this breakout on energy. Materials, after pulling back throughout the month of January, starting to move higher here in February in a range, but I would say 70 up to about 78 is the area I would watch. And the XLB currently 74.34, right in the middle of that range. Financials putting in a nice little cup, maybe a handle forming here. I expect we're going to see a breakout in the financials, especially if that 10-year Treasury yield continues to move higher. Utilities was the weakest link on Friday. Of course, the defensive group hasn't really performed very well. And while we look at all these other charts with these AD lines really strong on the major indices and all the sectors, look at utilities. That AD line is actually near 6-month low, much closer to a 6-month low than a 6-month high. So there are some areas of the market, obviously, that are still weak on a relative basis, but a rising tide lifts all boats. I believe utilities go higher. I just don't think they're going to outperform. Last thing I wanted to mention from Friday, as far as headlines, volatility index closed below 20 for the first time since the pandemic began. We've come down a few times and tested this 20 area, but we have not closed below it until Friday, 1997. I'm going to get into that in just a minute and tell you what I think the significance is there. 10-year Treasury yield. First, as far as economic reports on Tuesday, we are expecting the February Empire State Manufacturing Index to be released. Expectation there, 5.7. January was 3.5, so we are expecting a little bit of a pickup there. You can see on Friday, 10-year Treasury yield breaks out to its highest level since we had that recovery back in mid-March. We tumbled, if you recall, all the way down to about 0.40. Then we rebounded back to about 1.27. Well, since dropping from that level at 1.27, we had not seen 120 until Friday. So not only do we see the VIX going down, which means fear is subsiding, but we've also got money coming out of treasuries, out of defensive areas. That's what's sending the yield higher. So really, it's just kind of falling in line, as far as I'm concerned, with a very, very bullish stock market. And that takes me to talking technically, where I want to bring up the VIX. So here's the chart on the VIX, and I can pull it up on a different style here. But you can see the VIX, which obviously skyrocketed back in March all the way up to 85, threatening those highs we saw back during the financial crisis in 2008. But from that level, we came back down as the market recovered. And then it's almost like when you have an earthquake and you have aftershocks, so here's the earthquake, and then you get these little aftershocks. That's really how the VIX tends to operate if you look back, study history. So once the market gets really nervous and really fearful, it starts to subside, but then anything can set it off very briefly. And that's where you get these aftershocks. Now, the last aftershock we had was with the Reddit traders, Wall Street bets, the hedge funds, couple hedge funds taking it on the chin over GME and some other short positions they held. A lot of folks, I think, were unusually nervous about that impacting the overall market for a long period of time. I did not believe that was going to be the case. And sure enough, the volatility came right back down. And now you can see there's that low close below 20, 1997. We had gotten down, tested the 20 area and actually went below it on an intraday basis, but we had not closed below it. Now the significance, and I wrote about this over at StockCharts in my Trading Places blog. You should go back and take a look at this article if you haven't already. But basically, I was pointing out, when you have a VIX that spikes above 30 and then comes back down and goes below 20, throughout this bull market since, this past decade, there have been 7 other instances where this has happened. And in each of those instances, what I did is I showed you the VIX close when it went below 20. These were the dates that we saw it. And this is where the S&P 500 was on these dates. So the last 7 times, this is where the S&P 500 was on the day, the close on the day that the VIX closed below 20 after being above 30. So fear is coming down. Fear, the VIX goes below 20, and this is where the S&P 500 is. Then I calculated a month later. Where was the S&P 500 1 month later? In all 7 previous cases, the S&P 500 was higher a month later, anywhere from 1.8% to 7.8%. That's pretty good variance. But even this 1.88%, if we tack on to where we finished at 39.34 on Friday, even the worst case scenario of the last 7 would put us over 4,000 on the S&P 500 within a month. So I believe we're going there. I believe we're going up. Now, we do have to be a little careful as we go through option expiration week, because a lot of the companies, a lot of the tech companies, you really have to pay attention to the stocks that have a lot of volume in the options market. If if they're heavily traded in the options world, then I think as you go into monthly options expiration, which is the third Friday of every month, which happens to be this Friday coming up, the 19th, when you get to that Friday, that third Friday, you always have to be cautious because currently the stock market has been producing a tremendous number of calls. We've been seeing a lot of calls being bought. And the way you can see this, I'm going to pull up a chart here. This is the VIX. I'm going to change this to the CPCE, which is the equity only put call ratio. Now, you can see it's been downtrending for the last year, but I'm going to change this a little bit. And I'm going to, let's make it invisible. We're going to make the chart invisible. And then the overlay for a simple moving average, we're just going to put a 5-day moving average. So basically what's going to happen is you're going to see all this noise kind of go away, and then it'll be smoothed out with a 5-day moving average. So there you have it. So we've been downtrending. So in other words, the stock market's been getting more and more bullish in the options world. And our 5-day moving average of the equity only put call ratio has dropped below 0.4. Now, this may look like it happens a lot. It really doesn't. And so if we go back and we look at this, say, over the last 10 years, you're going to see that since the pandemic hit, a lot of folks have been playing these options. But typically, if your 5-day moving average goes below 0.5 historically, that's been a time when options traders are extremely bullish, very complacent. And normally, as you go into options expiration, you want to be very careful when everyone is buying calls, because as the market's been moving higher, those who have been buying calls have a ton of in-the-money call premium sitting on the table. And that is literally like a thief walking into a store with the cash register being open. It's very tempting for the thief to stick his hand in the drawer, take the cash, and run out. Well, same thing goes for the market makers when you look at options expiration week. As we get closer and closer to Friday, and possibly even to the early part of next week, because many options, if there is value, many option holders will exercise those options and buy the stock. And so if you buy the stock, then the market maker becomes a short at that point. So it can go into next week. I mean, if they're still short by the end of the week, then it's still in their interest to start of the following week to take the market or those particular stocks lower. So I would just be really careful. I'm bullish, extremely bullish, but you do have to be aware of the market inefficiencies that are out there. And one of them is when monthly options expire. And as they expire this Friday, we could see more volatility. We could even see a sudden bout of selling at some point as we get closer to the end of the week. So short term, we've got some issues with options. So maybe we pull back, maybe we don't. It's hard to say. I think you've still got to be cautious and at least be aware that this exists. But as we go out a month, if we look back at the article here and we go out a month, chances are, based on history, it looks like a month from now we're going to be higher. So I would say if we do pull back as a result of options, you might want to be looking at that as an opportunity in the short term to jump in. If you've got cash. If you don't have cash, it might be worth maybe booking some profits, building a little bit of cash in the event that we see some selling later this week. Just a couple things to think about. All right, I'm going to move on into seasonality. And with seasonality, well, let's see. I think I can probably go back here. All right, let me pull the chart list up, because we have a chart list that we have available for our members at Earnings Beats to download each month. So for February, we had 20 stocks that we send. So we send out 20 stocks to our members, and essentially we look at the NASDAQ 100 and the S&P 500, and we essentially try to put together the top 20 that we believe, the top 20 seasonal stocks for that month. So for the month of February, you can see these are the stocks. These percentages, for instance, on Etsy, where you see the percentage in the title here, it's telling us that 80% of February's Etsy goes higher. And it goes higher to the tune to an average of 16.4% during the month of February. And if you wonder where that information comes from, if you go in here and you look at seasonality and you pull up Etsy, it's going to come up with a 5-year. Now, this only goes back 7 or 8 years, I believe, 7. And the percentage now is 83 because when we started the month, it was 5 of the last 6 years, or excuse me, 4 of the last 5 years. So that's 80%. Now, because we're up this February, it's 5 out of 6, which is 83%. And if you go back 7 years, you probably drop this back to 6. No, let's see here. Yeah, if we go back last 6 years, it stays the same. So if we go back to a 7th year, it just means in that 7th year, February, there was no trading in February. So it must have started sometime after February. But when you look at these numbers, 83% of the time it goes higher. And now it's up to a 16.6 average. And when you look across all of the other months, only April, which has been up every year and averages 19.5%, that's the only month that's been better for Etsy. So this was a chart that we certainly wanted our members to be aware of. And as it turns out, at least for now, Etsy doing very well in terms of its performance so far in February. The stock is up 17.46% currently this month. So that's kind of in line already with that 16% average. So it's interesting to at least be aware of these seasonal tendencies of the stocks. Now I'm going to pull up a few others here. Let's go back into that chart list. All right, so Etsy we looked at. The next one I want to pull up that's doing pretty well here is NXPI. So it's the semiconductor stock. NXPI is up 21% so far in the month of February. So we closed down here around 160. Now we're at 194. So up over 20%. This is the best one. No, it's the second best one so far this month on our list of February performers, top performers. But you can see another very nice move to the upside, breaking out the new highs, and it's according to its seasonal pattern. This is what an XPI does, tends to perform very well. All right, let's look at FTNT. So FTNT goes up 82% of the time, 82% of February's, and average 6.7%. It's already up 13.8%. You can see breaking out above all these tops. But going into the month, it's good knowledge to know when you've got a stock that's trying to make a breakout that, hey, if it makes the breakout, it happens to really love this month. So that one was pretty timely. Next up is APTV. Goes up in February, 78% of those months, February's, and averages 6.5%. It is up 16.98% so far. And once again, breaking out to a new high. Two more. Zebra, which has just been a monster. It's in our portfolios as well, one of our portfolios. But it came out with earnings last week. Big move up. It's in a great area of the market. Look at the relative strength of its peer group. And look at the relative strength of Zebra relative to its peer group, relative to the S&P 500. And there's its peer group going higher. And oh, by the way, we're setting a new high on the AD line, accumulation distribution. So there's really nothing not to like here. But February, historically, is a good month for Zebra. It's up 23% in the month of February. This was given to our members back at the beginning of the month. And then finally, the last one I'll point out here is ANSS. This is ANSYS, ANSYS, and a breakout here. The stock's up 13.89%, and it goes up 79% of February's, and it averages going up 4.2%. So it's easily outperforming that this February. So anyway, just wanted to point out the seasonality charts. We do provide a chart list of the top 20 seasonal prospects for each month. So when March rolls around, we'll do it again for March. All right, next up, let's take a look at, how about we jump into earnings spotlight and pull up a few charts that some will be reporting tomorrow morning, some will be reporting tomorrow evening. CVS is the first one, CVS Healthcare, moving up nicely on an absolute basis. That's good. Pharma's, at a 52-week high just a few weeks ago. That's not bad. But when you come down here and look at the relative strength, pharmas are at a 52-week low relative to the S&P. CVS, though, relative to pharma's okay, relative to the S&P improving. This one's kind of middle of the road for me. I'm not overly excited about it going into earnings, but there's certainly a lot of other charts look worse. Next up, ZTS. This is Zetas or Zotis. This also is in that pharma area. And you can see on a relative basis, it's been struggling last few months versus both its peers and the S&P. And as I mentioned, pharma is not a great area of the market. AD line looks pretty good. Or no, this is pharma. I'm sorry. Here, the AD line looks pretty bad, actually. So this one makes me a little nervous. I don't like that AD line. I don't like the recent weakness in the relative strength. The group's not very good. This is not the kind of stock that I would want to hold into earnings, just from just my own personal opinion here. PLTR. This is Palantir that will be reporting tomorrow morning, Tuesday morning. And this has been a pretty good performer. I mean, when you look at the software group overall, and then you look at the stock relative to the software group, software relative to the S&P has been strengthening. All of this points to the chance of a pretty good report here. And this stock was $45 just a few weeks ago, and now it's trading at 31 and change. If they come out with good numbers, I could see this stock going back up toward the top of the range. And if they come out with good numbers and you get a negative reaction, say we move down to the 50-day, I wouldn't be surprised to see a big bounce off of that. So I'm expecting good numbers here, and it just depends, what kind of a Wall Street reaction we get. But I wouldn't be surprised to see a good report and a positive reaction on PLTR. We'll see. IPGP. This is IPG Photonics. AD line looks pretty good. Stock's been in a nice uptrend. The group, one of the best groups in the market, as you can see down here, the same group that I was talking about earlier with Zebra. And relative to the groups, I mean, the stock's been good. I expect a solid report here, and I wouldn't be shocked to see a breakout. Like Palantir, if we get a pullback, if it's a good report, we get a pullback, I think that 220, 230 area would be very solid. So let's see what happens after earnings come out. And it is a little bit of a crapshoot as we head into earnings. But IPGP, I think, is in a good spot. Looks good on the chart. I think they'll come out with some good numbers. How about AAP? This is Advanced Auto Parts. AD line, starting to trend back down. Got a lot of support coming in here on the stock around 143 or so. 143, 144. Don't want to go below that level. We're talking many months where that support level has been holding. On a relative basis versus specialty retailers, we're at about a 10-month low on AAP. Relative to the S&P 500, 10-month low. And specialty retailers haven't really done much the last few months. So an underperformer in a not so great group, I wouldn't want to be holding into earnings. There's a reason why stocks like this are not performing well, and so I would be a little careful here. All right, let's look. Let's do one more for tomorrow morning. AutoNation. AD line looks great. Stock's been trading higher. Now, this is also in specialty retail, but as specialty retail hasn't done much, look, now you've got a leader. So if I'm looking at these two stocks, Advanced Auto Parts, AAP, and AutoNation, AN, and you ask me which one am I more comfortable owning or holding into an earnings report, I don't know how they're going to turn out, but for me, is no question, I would much rather hold AutoNation because it has been outperforming. I think that's telling us Wall Street's expecting a good report here, and we'll see what happens in the morning. All right, Tuesday evening after the close, some big reports coming out. How about Agilent, ticker symbol A? This is Agilent Technologies, AD line, not so great, in an uptrend. Market, of course, is in an uptrend, though. It is in medical equipment, which has been so-so. of late, past few months. But this is one of the leaders. I think it's an okay looking chart. I'd prefer the AD line being a little bit better, but all in all, I would rank this one in the top half for sure, maybe the top third of companies out there. So I expect we'll probably see some good numbers. Ring Central breaking out before earnings, AD line starting to strengthen again. Look at the relative strength here. So computer services group, not very good versus the S&P, but Ring Central has been a tremendously strong stock. So in the portfolios, I normally look for everything going up left to right. This is the type of stock, if they report strong numbers, that I could go with and ignore the industry group underperformance. I think this is a chart that actually looks pretty good going into earnings. How about Occidental Petroleum, OXY? AD line starting to strengthen, price is doing better. The group is doing a little better. Stock relative to the group's been doing better. I mean, it is better than it's looked in the last 3 months is better than at any point prior to that over the last year. Volume was picking up here back in November and December, kind of slowed down a little bit. I would really like to see a good reaction here because we're up against some pretty key resistance, gap resistance, price resistance. 25 to about 26 is overhead resistance. I don't know. This one kind of could go either way for me, so I'd be a little careful. One other one I'll pull up for tomorrow evening, and that's Solar Edge. This is in the renewable area. AD line still looks pretty good. The stock got hit a few months ago back here with its earnings. I think that was earnings related, and then we rebounded back to new highs. I think this is a stock that looks like it wants to go higher. The renewable energy space has been strong. It has, well, maybe I should backtrack here because I don't mind a pullback in relative strength, but we've gone all the way to a 52-week low. So renewable energy would be a great sign for renewable energy if Solar Edge reports great numbers and breaks out, because if you got your weakest stocks doing well, that should tell you something about your strongest stocks in the space. That relative strength line bothers me. I probably want to pass on it. I take back my comment. It looks like it wants to go higher. I think the group still looks good, but I don't know about Solar Edge. All right, 3 you must see. Got to go through these very, very quickly. First one is NXGN. Pulls back, hits price support here. I think this is an area where we could see a nice rally. Then we've got WETF, which is Wisdom Tree Investments. Just made a new high on Friday, closing just above 580. I think that's bullish. And lastly, MANH, that's Manhattan Associates. Beautiful looking chart. And when I look at the relative strength, this is one of your leaders in software. Keep an eye on it. All right. Appreciate everybody taking the time to listen in. And I wish everybody a great Tuesday. Join me over at Earnings Beats on Wednesday morning for your next Trading Places Live. Have a great day, everybody. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.